Hey everybody, and welcome to Ascentis TV in the thick of the British summertime. Remember, there's no such thing as bad weather, only inappropriate clothing. So we've got a packed show for you again as usual. I'm going to kick off with Lee Koznowski, who is continuing his series of features on credit control, making sure you guys get paid. He's got an aspect on Xero that he's going to take you through on invoice reminders. And we've also got a fantastic interview with a great client of ours, Gemma from Lead Tech. She's going to discuss how they've used apps in their business to improve credit control and increase their cash flow. Enjoy this.
Hi everyone, in the last episode of Tech Talk we used technology to have a deep delve into company financials for your customers. That really logically leads us on to how we can then use technology to actually collect debts that you've got outstanding at the moment. And where else to start other than Xero? Xero can actually prepare many of the fundamental tasks required for credit control. Within the invoices module, you can actually turn on the invoice reminders just by clicking here. This is going to give you the option of sending automatic emails, either 7 days, 14 days, 21 days, or any other day schedule that you wish to add. And it gives you the functionality of editing the actual reminder to make it a bit more personal, and also to limit when you send reminders. For example, you could remove sending reminders for an invoice under £10 or £5. Back to the invoice module again, and you've also got here the ability to send supplier statements. So again, you can customize who these are sent to, by either selecting all, just a few, or excluding those that you don't want to send to. So very useful to just send out a bulk supplier statement to all your customers. Coming back to the invoice module again, and if you actually click on a specific invoice, you got the option here to add a note or an expected payment date. So there's a note already in there and an expected payment date on this particular invoice, and you'll be able to see that information in full within accounting reports and the customer invoice report just here. And there you see it. But by their own admission, I think Xero would say that can be quite limiting. And they've used 25 invoices a month as an example. Maybe at that point you should look for a single source app to help you with debt collection. Now there's a whole plethora of apps out there on the Xero marketplace that can do this. I've honed in on two really. Firstly, we've got Cetago. We've got a partnership with Cetago, and after the Q&A session I had with Ashley in the last episode, Daniel Calcott of Cetago took us through the credit control facilities. Here's a video that he did for us then.
Hello, my name is Daniel and I'm one of the account managers at Cetago. Today I'm going to give you a quick overview of our credit control feature. The Cetago credit control tool is designed to prevent issues happening between you and your customers. It's there to drive a reduction in days beyond terms and debtor days, making sure your bank balance is healthier. This solution can be fully integrated with a chosen email domain, so it can be implemented as an extension of your current credit control process. The first thing we need to do is come to the templates. There are three types of automated email. The first is invoice reminders. The schedule has up to 5 reminders. You can choose when you want them to be sent and what you want to send. As you can see, we have a best practice default template, but they are all customizable, meaning you can edit the templates as you wish. You're then able to preview the template to make sure it's exactly how you want it before it is sent to a customer. Then we have monthly statements. These give the customer a clear overview of the balance they owe and what invoices that comprises of. If a customer has more than one outstanding invoice, it will group them in a table rather than firing multiple emails at once. Lastly, we have thank you emails. This is a really popular part of Satago. Automate thanking your customers for payment. It's also a great place to add review requests and other calls to action to secure more business. What you send and when you send it can be managed within the settings. Email types can be toggled on and off. You can even choose the time of day you prefer these emails to be sent. As mentioned earlier, you can fully integrate this solution with a chosen email domain, so all emails sent will come from that email address, and any responses will go to that chosen email address. There are two other important screens to see within the credit control. We have the outbox. This gives you visibility of what's due to be sent out, and even the ability to stop specific emails from being sent if needed. We then have the sent box. Within the sent box, you have a complete log of everything that's been sent and when, meaning you have a full audit trail if required. So that concludes the overview of the Satago credit control feature. If you have any questions or would like to learn more, please let the guys at Ascentis know. Thanks for listening.
Thanks for that, Daniel, and hopefully that gives an insight into some of the additional functionality that you can achieve by using an app to do your debt collection. Now, one of the other big players in terms of debt collection, and in fact probably the highest rating on the Xero marketplace, is Chaser. And to give people an understanding from a customer point of view, I had a quick chat with Gemma David from Leeds Technologies as to how they use Chaser and what they did about converting from their systems, the original systems, into a tech-based solution. Now, Leeds Technology at the time were one of the biggest users of Chaser, so I figured she'd have some really useful insights for people. Hi Gemma, and welcome to the wonderful world of Ascentis TV. Thank you very much for joining us.
Thank you for having me.
And let's jump straight into Chaser. So I understand you were on a manual system initially, and you changed across to Chaser. So what was kind of the biggest issue you were facing when you were on this manual system?
We invoice every 2 weeks, and we've got about 150 clients. So I was invoicing quite a lot, and all the clients were on different payment terms. So it was quite difficult for me to keep track of who should be paying when and what was due.
Yeah, a lot of manual systems can just lead to errors and incorrect chasing, really, can't it? So you've made that leap of faith to looking at technology. So what kind of procedures did you put in place to try and find the right app for yourself?
We had a really good consultation with John. He told us what was out there, and we trialed Chaser, and it did exactly what we needed it to do very simply.
Did you trial any other apps or?
No, we didn't need to. Chaser did what we needed it to do, so we went straight with it.
Perfect. And I guess one of the biggest challenges in getting people to change from any system into technology is that initial setup. So can you just take us through what you had to do to actually get yourself plugged into Chaser?
Yeah, the initial technical setup was really quick. It was just an API that automatically linked into Xero, and the data was there. I probably put aside about a day, because within Chaser you can set different schedules and different templates. So there was a lot of copying and pasting and just tweaking it to how we wanted it. But the initial technical setup side of things was really quick and easy.
Okay, so you're a day down in terms of time. How quickly did using technology and Chaser help get that day back and then save you time in the future?
Immediately. I used to have time blocked out every day to do chasing, to see who was due and who had paid. But Chaser did it straight away. I got daily reminders when the emails were being sent, and I didn't need to do anything. It instantly saved me time.
It just takes that thought process away from you as well, doesn't it, by sending you the reminders?
Exactly.
Okay, so any words of wisdom for anyone looking to make that leap of faith into technology?
The systems are only as good as the user. So make sure that your banks are reconciled, any recent payments are marked on Xero, because Chaser will take an initial push just before it sends the chasers out. So make sure everything is up to date.
Yeah, makes sense. Your Xero's got to be right, because this just plugs into Xero and gets the data from that, doesn't it?
Exactly, yeah.
So I did say actually at the beginning of this that you were one of the biggest clients for Chaser. You're no longer actually using Chaser because you're using an even more efficient method of debt collection at the moment. Do you want to take us through what you chose to do?
Yeah, we now take payments by direct debit. So we've moved across to go cardless. Everybody's on the same payment terms, and we just didn't need the Chaser.
Completely eliminated the need for any kind of debt collection at all by just taking everything by direct debit. The perfect solution to debt collection, really, isn't it?
Yeah, because if there is an outstanding debt or something fails, then it's something that needs a bit more investigation than just a blanket template email. So, but that's very few and far between. It's definitely a lot easier this way.
And payment services is something we're going to look at in future episodes of Tech Talk. So thank you for that. And thank you for your insights into Chaser, Gemma.
Thanks for having me.
Gemma was really keen to stress at the end of that conversation that Chaser had done a fantastic job for Lead Tech, and it was through no fault of theirs that, fortunately, Lead Tech could operate the direct debit system. Not all businesses are going to be able to do that, and so apps for debt collection are still going to have a big part to play. Now, as I said previously, we've only really scratched the surface by looking at Cetago and Chaser, and our good friends at App Advisory Plus had done a comprehensive comparison of 4 of those apps out in the marketplace, and I'm going to leave that at the end of this Tech Talk just to give you an insight into all the different things you can look at.
Great stuff, Lee. A couple of good options there for you guys on either using invoice reminders, or if you can get your clients onto direct debit, then all the better. Okay, it's time for Financial Mastery and the mini-series that I've been doing on Back to Basics. I'm going to summarise those 3 statements for you this time. Hi everybody, and welcome to Financial Mastery and this little mini-series that we've been doing called Back to Basics. In this episode, I'm going to summarise the balance sheet, profit and loss account, and cash flow statement and how they relate to one another. It's important that you watch those prior episodes before you watch this one. For those of you that did watch those episodes, our little baked bean company statement should be very familiar to you here. You'll also remember from episode 1 how we introduced you to the concept of a profit and loss account by producing a profit and loss account from an individual's payslip. That actually wasn't a profit and loss account. It was an income and expenditure account. And the difference between a P&L account and an income and expenditure account is an income and expenditure account ignores the nature of transactions, i.e. whether they are revenue and belong in a P&L account or capital and belong on the balance sheet. It also ignores the timing of expenditure, the concept of accruals. And in very basic businesses, this can work. For micro businesses, you don't really need a balance sheet. And lots of very small sole traders will just do an income and expenditure account. But for any business of a substantial size, and certainly those that are governed by company law, you need to produce a profit and loss account and a balance sheet. For argument's sake, though, what I've done with our little baked bean company is I have produced an income and expenditure account. So I've ignored the timing of expenditure and I've ignored the nature of the expenditure. Go back to episode 7 on the cash flow as a reminder of where these figures came from. But you will see that the sales on the profit and loss account that we had of £2 million have now changed to £2,040,000 because I've added on there the additional money that was collected from the debtors and appears on the bank statements. Our cost of sales have changed to purchases, and I have increased those for £30,000 more that we bought in stock, which of course would sit on the balance sheet ordinarily, but it's just going straight through the income and expenditure account. And I've reduced the cost of sales for the amounts that we haven't actually paid to the suppliers yet. I've removed depreciation and just replaced it with the purchase of the canning machine of £100,000. And you'll see there's a new line here as well for loan repayments. Previously that's on the balance sheet, but I'm just expensing that straight through this income and expenditure account now, £300,000. And finally, in our simple example, you will see that the corporation tax that was in the profit and loss account that related to the current year's profit is now actually just the amount that we paid in respect of last year. Now you can see down at the bottom here that I've added on the opening bank account balance of £115,000, and with our income over expenditure of £520,000, that gives our closing bank balance. You can therefore see that we don't need a balance sheet. All of the transactions, whether they be capital or revenue, and the timing of them purely relates to those that have gone through the bank statement, they're all included in this statement. There's no need for a balance sheet. But of course, what this does is it robs the stakeholder of that richness, of that deep understanding of the true profitability of the business and the true value of the business, and of course, the risk of investing, working for this business, selling to this business, or buying from this business. That's why we apply accounting principles and policies that divide income and expenditure up according to the way that they behave, the nature of the expenditure, should I say, whether it's revenue or whether it's capital, and deals with the timing of expenditure. So whether we pay for an item or not, if we purchase that item, it should be in our profit and loss account. So because we've got these two statements where income and expenditure can both be allocated, you'll remember from episode 7 on the cash flow that the profit at the bottom of the P&L account never agrees to the balance in the bank. And that is why we have this third statement, which reconciles the profit to the balance sheet bank balance because of the way that we apply accounting policies and principles. And that is called the cash flow statement. Take a look back at episode 7 as to how that statement is prepared. But that's the principal cause, well, that is the cause of the cash flow statement, because income and expenditure is allocated to the profit and loss account and the balance sheet according to accounting principles and policies that gives us that truly rich, deep understanding of the performance of a business. I'll see you in the next episode. Bye for now. Okay, so that wraps up my Back to Basics series, because in future episodes of Ascentis TV, we're now going to take a look at much more advanced reporting on the profit and loss account and the balance sheet. Okay, it's time for Mark Overend's tax tips, and this time we're looking at cycling.
So for this month's tax planning section, we're going to talk about the Cycle to Work scheme. Often we're asked various questions about the Cycle to Work scheme, ranging from what is it to how can I qualify, or even how does it work? So what we're going to try and do in this section this month is answer pretty much every question we've ever been asked about the Cycle to Work scheme. And there's no better place to start than what is the Cycle to Work scheme? Well, the Cycle to Work scheme was introduced back in 1999 and is a government-backed scheme that allows employees to obtain, as a tax-free benefit, a bicycle and associated safety equipment through a salary sacrifice arrangement as part of their employment package. Now, who's eligible for this? Well, as I suggested earlier, it's for employees. They must be an employee of a company and taxed through the PAYE system. Any individual must be aged 16 or over. And in terms of the amount that they're going to be salary sacrificing to pay for this bike, the amount that they sacrifice mustn't take their net take-home pay below national minimum wage levels. Assuming they meet all of those eligible criteria, how does it work? Well, I mentioned it's a salary sacrifice scheme earlier. For those of you not familiar with the term salary sacrifice or the mechanics of how it works, a salary sacrifice scheme allows employees to receive their remuneration for their employment in means other than as a cash paid through the payroll. So normally, if you earn £20,000 a year, you would expect to receive £20,000 in cash after tax and national insurance has been deducted. If you salary sacrifice part of your wage, let's say you salary sacrifice £2,000 to pay for your bike, then you would receive £18,000 through the payroll, and the other £2,000 goes to pay for the bike. At this point, I potentially see some furrowed brows. Well, what's the benefit to the employee and indeed the employer of doing that? Well, if you salary sacrifice part of your wage to pay for a tax-free benefit, then the amount that you salary sacrifice is no longer subject to income tax or national insurance. So going back to my example before, if you were paid normally £20,000 a year through the payroll, you would be subject to income tax and national insurance on £20,000. If you salary sacrifice part of that, then actually, in my example, I said £2,000 goes to pay for the bike. Well, now £2,000 is tax-free, and you only pay tax and national insurance on £18,000. So suddenly £2,000 of your annual salary is tax-free, and it's paying for your bike that you use. Well, actually, the scheme rules require you to use it 50% of the time to commute to work, but the rest of the time you can also use it for social and domestic pleasure. As an employer, the same rules apply in terms of tax and national insurance and how a salary is taxed. And so for employers, the saving is on employers' national insurance. In my example, again, normally you'd be paying employers' national insurance on £20,000 salary, but where part of it has been salary sacrificed, you're only paying it on the remaining amount. So in my example, that's an £18,000. So there's a saving for both employee and employer to be had there. Often we're asked if it's only bikes that can be obtained through the scheme. Well, fundamentally, the answer is yes, it is only for bikes, but you can also get associated equipment for your bike through the salary sacrifice scheme. So if you're getting a bike, then you can also get a helmet, safety cycle clothing, lights for the bike, and various other minor aspects that you might get for your bike. How much can be spent is the next question we usually ask if people are interested in the scheme. The answer is there is no limit. So you can afford basically any bike that you can afford to get through the scheme is available to you. So for any mad keen cyclists who've got their eyes on a 10 grand bike, you can certainly do that through the scheme. And indeed, there is no limit to the number of bikes you can have through the scheme. I am aware of some friends who are keen cyclists who have more than one bike, and it is possible to get more than one bike through this scheme. Are there any catches? I hear the cynic out there saying, well, no, not really. The scheme is written into UK legislation, and therefore it's approved by the government. There's nothing there to trip you up. In terms of how the system works, the scheme is designed for the individual, the employee who is taking the bike, to effectively enter into a hire agreement, first of all, for the first 12 months to hire the bike. There can't be any guarantee through that hire period that they will actually take ownership of the bike at the end of the agreement, although it can be an option for them to do so, and often they will do it. It simply can't be guaranteed. Because of the nature of the hire agreement and having to put the necessary paperwork in place, you are required, whoever draws up the paperwork is required to have an FCA license. And in order to have such an FCA license, it's only regulated organisations that can deal with the paperwork. So most employers and indeed many accountants aren't really able to deal with the paperwork in terms of dealing with the hire agreements. And so usually in terms of getting the schemes set up, you need to get the company who's supplying the bike to do the paperwork for you. Now, in my experience, most cycle shops or suppliers of bikes through the Bike to Work scheme are more than happy to deal with that administration for you and are already set up to do so. What if an employee leaves during this agreement? So I said before, they enter into a hire agreement. It's usually for at least 12 months. What if an employee leaves partway through that? Well, in that case, the remaining balance on the hire agreement can be deducted from the employee's pay. And if they settle the amount outstanding on the bike, then they can actually take ownership of the bike. Otherwise, you would have to retake ownership of the bike and return it. The employee would need to return it as part of their leaving package. Okay, for today's quick tax tip, we're going to talk about what you can do if you are trying to incur some expenditure before your year end, but for whatever reason, for delays, you aren't able to make the payments in time, and the payment end up being dated after the year end date. So often we're having pre-year end tax planning meeting. We might talk about making pension contributions, buying fixed assets, all that sort of thing. And, with time pressures, not everyone is able to deal with the paperwork in order to get the expenditure done before the end of the year end. And one of the questions we're often asked is there anything to do about it? Well, yes, there can be. One consideration is to think about changing your company year end. The downside to missing the payment deadline if your year end passes is, of course, you're going to have to wait another 12 months in order to get your tax relief. One option open to you is extending the company year end. If, for example, your normal year end is 30th of April, you could move it to the 31st of May if that payment didn't go through until the first week in May, perhaps. Now, one word of caution, you can only change your company year end under normal circumstances once every 5 years. So it's not something to be done lightly, and it's not something you can rely on doing every year. But if exceptional circumstances have occurred and it's appropriate to do so, then you should look at extending your year end in order to accelerate the tax relief that you can be obtained if you've missed your payment deadline only by a few days or perhaps a couple of weeks.
Cheers, Mark. Great advice for anybody living somewhere relatively flat, because it would take wild horses to drag me to cycle to work. Okay, it's time for Lee's admin min now, and he's going to bring you up to date with all of your commitments from a tax and accounting perspective. Take it away, Lee.
Hi everyone, we've got all our usual deadlines on the screen highlighted for your attention, and I just wanted to bring to note some of the more notable ones that might need a little bit of planning. From the 1st of August, HMRC have once again reduced their contribution to the CGRS claim, so they're only going to pay you 60% now, and you're going to have to make up that shortfall of at least 20%. With personal tax, we've got the self-employment income support scheme applications imminent. We've also got 31st of July coming up, which means the payment on account, the second payment on account for your personal tax return is due. Going a little bit longer into the future, on the 30th of September, we've got quite a few key things happening. The CGRS scheme closes. We've got the end of the 5% VAT rate on hospitality. That's going to go up to 12.5%. And we've also got the last day for the self-employment income support scheme, and also the apprenticeship incentive scheme. So that's an extra £3,000 on any apprentices that you hire between April and September. A little bit longer into the future, we've also got the end of the recovery scheme on the 31st of December. And at the moment, the annual investment allowance is going to reduce from £1 million to £200,000. So there might be a little bit of planning required for capital expenditure. Mark's probably going to do a bigger piece on that in his tax tips, probably after the budgets, because these things can always change.
Thanks for that, Lee. Okay, guys, you're all up to date with your commitments. It's the end of the show, and thank you for watching as always. Hit the bell, subscribe at the bottom there so you don't miss out on future episodes. And if you're not a client of Ascentis and you're interested in speaking to us, jump onto the website and just request a discovery call. We'd be delighted to talk to you. That's all for this month. We'll see you next time. Bye-bye.